Our market monitor guest predicts 2014 will move toward a, quote, more normal market and interest rate environment. Janelle Nelson is portfolio analyst at RBC Wealth Management. Janelle, nice to have you back on the program.
Great to be here. Thanks, Susie.
So let's talk about what's normal and what's changed that makes you see 2014 as a more normal market environment.
Well, I think what's changed is since the financial crisis in '08 and '09, it's been a risk-off, risk-on market. It's been, is the Fed easing? Are they going to do more quantitative easing? And now we're back to a point where the Fed's beginning to taper. Growth is coming back to the U.S. and the rest of the world. And I think that you're seeing stocks respond to earnings, and stock picking once again, I think, will be a good thing to have in the marketplace.
What kind of stocks? What's the theme you're looking at? I mean, do you go with what we would call an early cycle group of stocks that usually do well as the economy begins to strengthen, or late cycle? I mean, where are we right now, do you think?
I think we're probably in the third or fourth inning of a 9-inning game. So we have plenty of room to move. So much has moved in 2013. This market was stronger than anyone really would have anticipated. That what I'm looking at for 2014 are stocks that are global in nature. I like blue chips that have lost their luster. Ideally, I like a few names that are trading below the peer group, and if they are steady dividend payers and or share repurchase candidates, even better.
Okay, and let's go down some of the stocks. And you have Coca-Cola at the top of your list, which sounds like it fits some of those criteria you just told us about. Tell us why you like it, because here's a stock that's pretty much trading where it was a year ago.
Exactly, and I think if you're in Coca-Cola or you've looked at Coca-Cola, you can look at the sugar tax in Mexico, you look at the cold weather, you look at the lower than average sales. It's not been a great year for Coke. China and Brazil have been weak, but we think a number of those considerations are going to turn in 2014. We see a rebound in both China and Brazil. GDP trends are trending higher. We also think that volume growth will improve. What drives consumption of soda more often than not is weather. We've had cold, rainy weather the first half of 2013, and I think that if we even get back to normal, I think that helps. So if you see a rebound in volumes for soda overall, typically Coca-Cola does better than average.
Coach fits the area as well. They've had a tough year. Their CEO is retiring early next year. A lot of competition from a Michael Kors and companies like that. Why do you like Coach here?
I think it's a global luxury brand that has not lost its cachet. I think the magic is a little worn, but it's coming back. I'm very excited about their Burrow brand, which gives you a first glimpse at what the turnaround could be on the creative side in the second half of 2014. In addition to that, you have a stock with a steady repurchase plan, a 2.4% dividend yield that's trading a full 4 multiple points below its luxury brand peer group.
Okay.
A lot of that bad news is built in.
We have half a minute left. Can you squeeze in a quick pitch about why you like Royal Dutch Shell B shares?
Absolutely. What worked in big energy in 2013 was restructuring. We think that's happening in Royal Dutch Shell in 2014. 5% yield while you wait, $7 billion of divestitures. We think the stock works.
Okay, great. Thanks so much. Any disclosures, Janelle?
Yes, actually, my company makes a market in all 3 stocks. Both Royal Dutch and Coca-Cola are clients of the firm, and a member of my household owns Coca-Cola.
Okay. Thanks so much for coming on the program. Have a happy holiday. Hope to see you in the new year.
Thanks, Susie. You too.
Janelle Nelson, she's portfolio analyst at RBC Wealth Management.